Good afternoon, everyone. Welcome to an exciting 50 minutes of Finanz und Wirtschaft webinar within the series of Nachhaltig investieren, neue Werte schaffen. My name is Ralf Kretschmer from EBG Investment Solutions in Zurich, and we're delighted to support this event as its knowledge partner. Please note that this webinar will be recorded. Sustainability has moved to center stage over the last few years. For instance, the World Economic Forum Global Risk Report 2020 puts sustainability as the key risk area by far. On the other hand, it becomes more and more clear that the necessary transition of most sectors towards sustainability probably provides us with the largest business opportunity in our lifetime. So in the spotlight are real solutions with real impact and real return. Let's look at the questions that were asked to the audience. So, if Joe Biden wins the election, how would be the impact on sustainability? So by far we can see should be positive if the audience is right. Do we have another question? Probably not. So today we have three distinguished experts providing us with insight on challenges and opportunities for investors associated with climate change and renewable energies. I welcome Mark Lacey from Schroders, Christian Atkinson from Fidelity International, and Fabio Pellizzari from Swiss Canto Invest. Thereafter, we'll have 15 to 20 minutes for questions and further discussions. You should find actually a button below on your screen, which is either named F&A or Q&A. And you will be able to submit your questions throughout the session here. Our first presenter today is Mark Lacey, Head of Global Resource Equities, Global Thematics at Schroders in London. He is the portfolio manager of the Schroder ISF Global Energy Transition and ISF Global Energy. And before joining Schroders in 2013, he was with Investec and Goldman Sachs, managing energy equities. The title of his presentation is The Structural Shift in the Global Energy System. Mark, please.
Thanks, Ralph. And hello, everyone. And hopefully you've got access to the slides that I'll be referring to today. Ralph highlighted the structural shift in the energy system. And that's really is what's happening. And in 10 minutes, which I've been allocated, I'm just going to take you through a few slides which really show the size of this impact and why this is effectively a long-term investment theme. This isn't a 1 year, 2 year shift in the energy system. It's not a cyclical move in the energy system. It's a structural shift, and it's once in every 100-year event in terms of we go through this structural shift in the energy system. What's driving this on page 2 is effectively the CO2 emission path that we're on. Which is unbelievably unsustainable now. I mean, if we carry on producing CO2 emissions and rising at this rate, and bear in mind last year CO2 emissions went up another 3.5%, we're on a path to a 4-degree increase in global temperatures, and that's very much unsustainable. And everyone looks at 2100 targets for that 4-degree increase, but we would look at the more important target in the near term, and this is the simple way to look at it. You need to reduce emissions by 33% between now and 2030. And bear in mind the amount of infrastructure that's already been put in place in the energy system. What really needs to happen is effectively, we need a massive structural shift in obviously the coal-fired power generation in particular. Thank you for putting the slides up, by the way. On the next page, which we've skipped onto, which is the perfect page, no, go back to the other one, please. Thank you. You can see that we've got are approaching what we would say is a global buy-in on the need to reduce these emissions. Prior to Joe Biden having and hopefully he does win the presidency, I'm still amazed by who actually, the 2% that voted that said they didn't think he was positive, Joe Biden getting in, but nevertheless, with regard to sustainability, Joe Biden's policy of $2 trillion, how much is that over the next 4 years? That's 5 times the run rate of fossil fuel capital expenditure over that same period. That's really important because it's a massive structural shift with the US in coordination with Europe and Asia. 750 billion is part of the recovery fund that's going towards renewables. And at the same time, China is basically indicating that they're going to spend around about 1.7 billion in new infrastructure targeting renewables. Again, it's the weight of money which really provides the longevity on this investment theme. And that cannot be understated, that it's a multi-decade investment theme, because it has to happen. If we go to the next slide, you know the system is changing because the major oil companies, which are big energy suppliers, particularly in transportation, remember 65% of all oil consumed is in transportation, they're now participating in this structural shift in the energy system, to the extent that companies like BP are letting their production slide by 40% over the next decade as they shift $60 to $70 billion of their capital into renewable power generation alone. And the only two companies on this slide that actually don't have a clear policy towards renewables at the moment, no surprise to us, is Exxon and Chevron. Over time, we think that will have to shift as well. But ultimately, this is a massive game changer for the energy industry, what's happening right now. If we go to the next slide, the scale of this decarbonisation and the electrification and the need for increased electrification has to be put into context. So if you look on this slide, renewables at the moment are around about 22% of the overall energy mix. They're actually expected to get to 85% of electricity generation by the time we get to 2050. So it's more than a fourfold increase without population growth. And what's driving this, as you'll see in a few minutes, is basically economics, as well as the need to obviously have clean power generation. The second part, which even adds to the growth, is the electrification of energy use. And at the moment, a lot of people listening on this call, a lot of the energy you consume is in the gas that you use to heat your homes or in the fuel that you put in your car. The adoption of the electric vehicle, for example, will double your electricity consumption on an annual basis for a household for 4. So we're going to see a huge need in power generation just from that change in the energy mix as a starting point, which is why the third component is very, very important. It is impossible to provide all this power generation globally without some energy intensity decreasing over time, which is why it's the entire value chain that needs to be upgraded. And I'll highlight that in a slide in a few minutes' time as well. It's not just renewable generation, it's everything all the way up to the plug socket where the investment is basically going across this entire value chain. And if we go to slide 7, please, so 2 slides forward. Thank you. The levelized cost of energy for power through renewables has now reached a point where it is unbelievably economically inviable. This is very important because if we go back to the period of 2010, where combined cycle gas turbines and coal were by far still the most economic means of producing power, same as nuclear as well. But now, on a levelized cost of energy basis, renewables are actually cheaper than both coal and combined cycle gas turbines, which is why we've reached this inflection point in about 2018 where we started to see an acceleration of investment rates in this sector. If we go to the next slide, you'll see how much that they've come down in terms of cost efficiency. So solar, for example, has been on average since 2010, the efficiency has increased by about 28% per annum, making it from unviable to viable. And then when you look at onshore wind and offshore wind, the average efficiency gain has been around about 11% per annum. But we would highlight that with wind in particular, there's a step change coming in the technology with regards to much bigger turbines, 16 and 20 megawatt turbines, which will see that jump down over the next 3 years, which means that offshore wind farms are unbelievably viable. But then the last point really is a consumer-driven cost trend as well. Lithium-ion battery packs, if we go back to 2010, at $1,200 a kilowatt hour, just weren't viable versus an internal combustion engine. Now in 2020, we've reached $100 per kilowatt hour. Why is that important? Because it means now the electric powertrain is on a cost parity with the internal combustion engine. And that means over the next couple of years, the consumer is going to have a choice which is cost effective relative to the internal combustion engine from the OEM suppliers for those vehicles. The next slide really captures what I was mentioning earlier, and that is, it is the entire value chain that needs to be upgraded. So on average in the US, transmission and distribution lines lose around about 20% of the energy from power generation up to plug socket. So as we put in these wind turbines and as we put in the solar panels, we need to put in the infrastructure that's suitable for these microgrids and localized grid setups. And at the same time, we need to increase the efficiency of those transmission and distribution lines for this to really be sustainable. This is the most important thing. So what we need with that is we need an upgrade in effectively substations, we need new storage facilities being put in place, we need efficient charging infrastructure. And that's why when we describe the upgrade in the energy system, it's not just about power generation, it's everything all up to the plug socket. Because this is obviously an investment forum, I want to just, in the last couple of minutes, highlight why this is an investment opportunity, and it's a long-term structural investment opportunity for investments. If we go to the next slide, please. If you look at the little green bars on the left-hand side, if you break up those subsectors from that schematic from the earlier slide, you've got clean energy generation, transmission and distribution, batteries and storage, and electric transport infrastructure. But if you look at the cumulative investment required in the context of that $100 trillion, which is to be spent over the next 30 years, the market capitalizations for these sectors are tiny relative to the investment rates. And this is a massive disconnect relative to other subsectors globally. In fact, it's really well captured on the final slide, which if we can go to that next slide, please. And this is the best slide in the pack. If you think about energy as a whole, as a percentage of the MSCI ACWI, it's typically trended between 6 and 9% over the last 40 years in terms of its market share. At the moment, fossil fuels has now shrunk to around about 2% of the ACWI, from peaking at around about 8%, as I mentioned earlier. And if you take those renewable sectors, which are receiving these investment rates, which is 5 times that of fossil fuels, this subsector in combination only make up 0.6% of the ACWI. Over time, these subsectors will grow and they will replace the fossil fuel exposure in that market because of investment rates. And so the key thing to take away from this slide is that this sector is going to grow and become a more and more important market share as we go over the next few decades. And as you can see on the left-hand side, Schroders provides a balanced approach to investing in this space. So I was allocated 10 minutes to present. That's 9.5 minutes I've basically presented. So thank you very much for your time. And I'm going to stay on the line for questions later. Thank you.
Thank you, Mark. We're coming to the next presenter. That's Christian Atkinson, Portfolio Manager of the Global Corporate Bond, Sustainable Reduced Carbon Bond and Global Hybrids portfolios at Fidelity International. He has 20 years of experience in the space and has covered a variety of sectors across investment grade, high yield, and emerging markets during that time. The title of his presentation is Sustainable Fixed Income Using Bond Investments to Reduce Carbon Emission. Please, Christian.
Thank you. Hopefully you can all hear me okay. I'm just going to try and share my slides, so please bear with me while I do that. Okay, so unless anyone shouts at me, I'm going to trust that you can all hear me perfectly clearly. So today I'd like to talk to you a little bit about how we can implement a climate solution within a fixed income portfolio. And I think Mark there did an excellent job of explaining what sustainable investing can mean in an equity context. But I think it's historically the fixed income has been a sort of less fashionable stepchild, if you like, of sustainable investing in an equity space. So there's 3 basic messages that I want to leave you with today. The first is that investing in a sort of more sustainable future, a greener future, is no longer an option. It is something that we all need to consider within our portfolios today, and I'll come on to some reasons why in a second. The second point that I would like to make is that active management and ownership is absolutely key to investing with integrity in a sustainable context. And the third and final point, in response to many of the questions that I often get when I'm talking to investors about sustainable investing in a fixed income context, is that you don't need to sacrifice return, nor do you need to sacrifice diversification to invest in a sustainable way. So turning over the page, why is climate change such an urgent problem? I think we're all very used to talking about this as a problem that we need to address in the future. This is something we do for our children, our grandchildren, for the polar bears, but you don't really need to believe that in order to switch your mode of operandus within the fixed income context. You really just need to look at the risks that you're facing in your portfolios today. And this was a presentation, a report that was published by McKinsey back in January of this year. So feels like a long time ago, but is only 11 months ago. And they discussed some of the physical, social, and economic risks that we're facing corporate investors in the current environment. And I'm not going to go through each of the examples here, but needless to say, we've had to add onto this chart, we've had to edit it subsequently to take into consideration things like the Australian bushfires, which burned an area basically equivalent to the size of Germany. Actually, it's about 91% of the size of Germany, landmass of Germany, that was burnt. The Siberian heat wave, which was supposedly a 1 in 800,000 year event, and therefore statistically should not have occurred. Scientists have pointed to that as evidence that climate change is very much real. So these are impacts that are being felt in your portfolios today. We need to incorporate them into the way that we think about risk, but also in the way that we think about returns going forward. So if we move on and think about this in a fixed income context, what does that actually mean? Well, for any climate aware portfolio, there are basically 3 success criteria that you need to think about. And the first is obviously a positive climate impact. The second is that you mitigate risks. And by that, I mean obviously climate risks, most obviously, but also that you're not replacing climate risks with some other form of risk, concentration risk, or exposure to particular segments of the market. And then finally, obviously, that you meet your return objectives. And that's something that I think most investors will understand. Now, there are basically 3 solutions within the fixed income market as we speak today. The first is green bonds, a very fashionable and rapidly growing market. The second is to adopt portfolio exclusions, which is something that fixed income investors are particularly used to doing when they face ethical considerations within their portfolios. And the final one is some sort of low carbon benchmarking exercise. So you either literally take a low carbon benchmark, or you try and run your portfolio through some sort of carbon screening. All of these have problems. We're going to address them one by one, and then we'll talk a little bit about our solution to that. So let's tackle with green bonds. So firstly, up front, I would like to say that green bonds, great innovation, something that I think has been absolutely valuable for the developments within the market. But it is problematic, and it is problematic because it is still a relatively young market. And if we think about those 3 criteria on the previous slide, the areas that green bonds fail to address, first and foremost, is actually in the return space. So green bonds are typically higher quality than a regular global corporate or aggregate benchmark, and therefore they are lower in yield just by virtue of being higher quality. But also, and probably more importantly, the green bonds are often issued with a premium, so a lower yield, to non-green bonds from the same issuer. So in other words, you're taking the same credit risk, but you're getting a lower return. Now, that to me doesn't seem like a very attractive proposition for most green investors. You're forced to accept lower returns simply because you have an environmental mandate. And the second issue, again, thinking about that risk side, is diversification. Because it is a relatively young market, we still have a lot of sector concentrations. And you can see from the chart on the right-hand side, it's dominated by governments and quasi-governments, alongside basically 2 other sectors, should I say, banks and utilities. And they dominate green issuance. And within those sectors, there is a concentration of particular issuers as well. So once you've put up, or you've gone to the expense of putting up a green bond program, you tend to repeat issue, but also that expense and that effort that is required to set up a green bond program is a deterrent to new issuers coming into the market. So lack of diversification, and that lack of diversification obviously means you're taking particular sector concentration risks. But also, because there is a smaller universe, and we can see that in the table on the left-hand side, basically 600 bonds more or less in the universe compared to 26,000 bonds in the Global Ag Index, there is a lack of alpha opportunities as well. Now, the final point is just to say, on the impact side, are we actually doing something positive for the environment? And I think, on the whole, I would say that green bonds are a positive movement in the right direction. However, the BIS, the Bank of International Settlements, published a report earlier on this month, basically saying that they questioned whether green bonds were a good indicator of companies decarbonizing. And actually what they said, it was far better to focus on the corporate level strategy and decarbonization rather than to look at these sort of asset level, these use of proceeds type bonds. So conclusion there is that green bonds, great instrument, but has to be used as a tool rather than a whole portfolio solution. So what about if we move on to the next slide? What about exclusion? Well, again, similar problems present themselves with exclusion. When we think about exclusion, effectively what we're doing is we're trying to remove companies from our portfolio that we consider to be culpable for climate change. And more often than not, the finger is pointed at the fossil fuel sectors, so oil and gas, coal, obviously, but also some of the other carbon intensive and hard to abate sectors as well. Now, the big problem with exclusion, in my opinion, is that actually that fails to address the problem. Right? And actually, the reason why I don't believe exclusion has impact is because these companies will continue to exist so long as basically one condition, actually, but possibly two, is fulfilled. The first condition is that there is demand for their product. If there is demand for their product, then they will continue to be able to generate a profit, earn a return, and therefore there will continue to be providers of capital who don't have an environmental mandate, like the charming gentleman on the right-hand side of this slide. So if you exclude these companies from your portfolio, you effectively hand the keys over to investors who don't have a climate change mandate. They maybe don't believe in climate change. And therefore they set the strategy, they set the compensation of management to be aligned with their beliefs. Now, I think it's far more powerful that we work with these companies to help them shift towards a renewable and greener strategy. And actually, that is the approach that we at Fidelity adopt. The second problem with exclusion is that you effectively have a similar problem to what you did with green bonds, is that you have a very concentrated portfolio in terms of the sector allocation. Here we see we've excluded some of the very hard to abate sectors, and effectively what we've got are some financials, some consumer companies, and some tech companies. Now, all of those are very low naturally in scope 1 and scope 2 emissions, but when this comes back to that demand point, really what we need to do is to tackle the demand for fossil fuels. And if we just exclude the supply side, then we're not dealing with both sides of the equation. Finally, what about low carbon benchmarks or low carbon benchmarking? Well, this is a relatively new field that we're still adapting and learning. But the two approaches to targeting carbon emissions, you either look on an absolute basis and then you face the problem of larger companies have larger emissions, or you try and normalize for the size of the company. And usually what is done when we normalize for the size of the company, we look at the revenue. So we carbon intensity per unit of revenues. And here on the left-hand side, we can see, we compare to utilities. We've got the carbon intensity in the middle, in the box there, that looks at the carbon intensity per unit of revenues. You can see these two utilities, one Spanish, one Scandinavian. Spanish utility has 1/5 of the carbon intensity of the Scandinavian utility. So if you were to optimize your portfolio, all you do is you buy the Spanish utility, you sell the Scandinavian one, you've improved your carbon footprint. The problem is when you actually look at it, these two companies are very similar in terms of their generation portfolio, and actually But part of the problem is that the Spanish utility is generating revenues from wires, from distribution networks that emit no carbon but do generate revenue. Now, the Scandinavian utility, for historical reasons, isn't allowed to own those wires. The second problem is that electricity prices in Spain are actually significantly higher than in Scandinavia, again, for geographical and historical reasons. Therefore, again, that dilutes the carbon emissions by a higher revenue number. So the approach that we take is to normalize by the units of power produced. And you can see that in the bottom row, that when we do that, we actually flip the conclusions. So the Spanish utility is actually more carbon intensive than the Scandinavian one. Now, the way that we approach low carbon investing at Fidelity is actually to combine the best of all three of these worlds. The first approach is, the first foundation to that is we invest in companies that are low carbon, lower in carbon than their peers. So we take those units of production metrics that I talked about in the previous slide, and we identify companies from a very narrow peer group that are the lowest in emissions, and we build a foundation of the portfolio. That reduces portfolio emissions quite significantly. The second point is that we then want to invest in issuers who are on an improving pathway. And this is some of those companies that Mark was referring to, companies that have a firm commitment to decarbonize in line with a 2-degree pathway. Now, they will naturally start to increase emissions within the portfolio again, but if we've done a good job with the first pool, then actually we have capacity to own some of those transition stories. And the third and the final approach is that we will buy green bonds. They're roughly about 20% of my strategy at the moment, but those green bonds must meet one of the first two criteria. So they must be low carbon issuers, or they must be on an improving pathway. This is the summary slide. I'm aware I've already gone over my time limit, so I'm going to stop right there. And if you have any questions later, please do say.
So thank you, Christian. Just for the audience, again, if you would like to submit questions, then you find a button, or should find a button at your screen that you can submit. It should be either Q&A or it should be F&A. So please make use of that if you have any questions to either Mark, Christian, or Fabio. Fabio Pellizzari, who will be our next presenter. He's the head of ESG strategy and business development at Swisscanto by Zurich Cantonal Bank. He's responsible for the sustainability strategy and its implementation across asset classes. And before joining Swisscanto, he was with Robeco Sam for 12 years, where he led most recently product management, quantitative research, and ESG country research. So he will present us his views on climate goal becomes investable. Please, Fabio.
Thanks. Hello, everyone. Very happy to be able to present here. Thanks also to Christian and Mark for their contributions and very interesting presentations, which go into similar directions in one or the other slides that I want to show. So I can just refer back to their presentations. Maybe you read earlier this year, the press, at least if you're here in Switzerland, what Swisscanto is doing to contribute with its investments to a greener future. So we have announced the climate strategy earlier this year in March for all our active managed assets. And I'm going to show you now on the next few slides why we're doing this, but also how we're doing this a bit more in detail. So the presentation. Now it works, sorry. So why are we doing this? We heard before from the presentation, there's significant risks but also opportunities involved in climate change. So on the one hand, we have increased regulation coming up for the financial industry. Probably all aware about the EU action plan that is gonna hit the market in 2021. But we also have more on the real economy side, the EU's green finance. So there's a lot of regulation kicking in around climate change. We heard China, I think a month ago, announcing they're going to be climate neutral by 2060. We heard several countries banning combustion engines from the roads. So there's a lot of regulation going on, which obviously leads to transition risk for certain businesses which have not yet been able or on a laggards in terms of adapting their business models. And then we have shifting consumer demands as well. If you read through the press and if you see some phenomena like Greta Thunberg, you see there's just the generation Y and younger generations seem to care much more about climate change and their future. Therefore, you also have a consumer consumers pushing for cleaner solutions, etc. On the other hand, we have the physical risk, and I don't want to go into details. We've seen a very nice chart before in, I think, Chris's presentation, which shows all the costs that can be caused by climate change through extreme weather conditions. And then on the opportunity side, obviously, we're also doing this because we see significant upside in companies that offer innovative solutions today and which are on the leading edge already in traditional business. We've heard, a utility example. If you have a Spanish or a Portuguese utility and you compare that to some utilities which still today use a lot of coal and fossil fuels, there's just significant difference and also significant risk. If regulation changes, they need to adapt their business models. And if you're a laggard today, it's going to be much more difficult, obviously, to transition your whole business in the coming years. So therefore, we think with our climate strategy that we have announced and what we're going to do, we are very well positioned to manage, on the one hand side, these risks, but on the other hand, also profit from the opportunities that arise through this big phenomenon, climate change. So what are we doing? We have committed to decarbonize our whole active portfolio. So we have set ourselves science-based targets, meaning our whole active range will from now on start to be on track for a 2-degree climate scenario. So what does that mean? On the right-hand side on the chart, you see how much carbon is burned today. So actually, if we go on like this, business as usual, we're not going to reach the targets, obviously. So we need to significantly reduce over the coming 30 years. We have to reduce approximately 70% of the total carbon in order to achieve the 2-degree scenario. So the total amount of CO2 that the economy is allowed to burn is pretty much the blue area underneath the chart up to 2050. So that is, IPCC estimates that this is like 1,090 gigatons of CO2 that we're allowed to burn in order to reach this net neutral by 2050. So the problem with this is at the current rate of how we burn, and we've heard before, like last year, carbon has gone up again. In total, we have approximately 50 to 20 years left, and then we have used the whole budget, meaning we're going to fail the target. If we want to reach the target, we have to decarbonize every year 4% total carbon in the atmosphere in order to reach the 2-degree scenario by 2050. So we think that, of course, regulation will kick in and will probably contribute parts of what is needed here, but it's not going to be sufficient. So also the private sector and also the financial industry, they have to commit and they have to contribute in order to achieve these targets, and therefore we have, as the first asset manager actually in Switzerland, committed to this target earlier this year, and it starts to kick in now. So we're going to lock in the benchmarks for 2019, and we start to decrease our carbon emissions by 4% every year, including nominal GDP growth. If you move on to the next slide, I want to show you a bit how we've done that. So first of all, I think it's important that you set the right framework around how you want to do it. So first, you need a strong governance in place, meaning how do you measure? Where are the responsibilities? What are the incentives of the management and of the organization to go that way? The second one is you need to start reducing your carbon emissions, obviously in line with the science-based targets to achieve that goal. And finally, you have to be transparent in the sense of providing all the footprints and the carbon emissions per portfolio for all the portfolios so that your investors know what they're going to get with the portfolio. And there are two ways, and I think also this we heard, exclusion is often not the best way. Exclusion is often to us more the last resort. But first of all, our voting and engagement. So through our engagement efforts, we want to move companies and to become carbon neutral by 2050, we encourage companies to sign the Science-Based Target Initiative. So basically start decarbonizing the portfolio by 2050. And the second part, obviously, and we've also seen that before, is capital allocation. So if the market is not doing enough, we're going to have to reallocate away from the Scandinavian utilities, as we've seen in the example before, and we have to allocate that towards the more sustainable Portuguese or Spanish utility in order to decarbonize the portfolio and emit less than the benchmark, and in order to meet our target. So here you see how that works exactly. So today we are 2020, we have an initial value of our portfolio. We're going to lock that in, so the carbon intensity. So remember, this is the total tons of CO2 divided by the revenues of a company. So we calculate the weighted average of the benchmark, and for each benchmark at each active portfolio, we get a target. So we know the benchmark in 2019, let's for simplicity's sake assume, has 100 tons of CO2 per million invested, per million revenues. We know it has to decarbonize year by year by 4%. That leads us approximately to 30% of what it is today. So hence we have to reduce by 70%. And this is what you see on the left-hand side by this green line. So each portfolio at any point in time has to be below that green line in order to be aligned with the Paris Agreement. So what is our expectation? We heard it before. So I've said there's going to be regulation kicking in from 2030. We expect this trend to increase even. So we have the market will hopefully contribute part of that decrease. And the other thing is, by us engaging with the companies we invest in, we hope we can also, and other investors will be engaging with company, we can contribute that the overall CO2 is going to come down. Whatever is not going to work, if the market stays above the green line, we have to do it obviously via reallocation of the capital away from strongly polluting companies and industries towards more cleaner industries and companies. And on the right-hand side, you see a concrete example. So what is the challenge here? So today we talk of 170 tons of carbon per million Umsatz. So we have two problems here. So we emit 170 per million Umsatz. So we need to reduce the 4%, but on top we have GDP growth. So we're going to have nominal GDP growth. If you assume a growth of 5% per annum in 2050, the economy will be 4 times as large as today. So if we continue at the intensity rates of today, we're going to have way too much carbon in the atmosphere. So basically, we can not only just reduce by the 4%, but obviously we also have to reduce by whatever nominal GDP growth we're going to see in the future, which then gives us the target for every year. So assuming in 2019 we had 100 again, we do the 4% and we had a 5% nominal GDP growth, we have to decarbonize all the portfolios by 8.57% until the end of this year, 2020. And this is how we hope we can, how we know we're going to contribute to a cleaner future. And obviously we think we have a very coherent strategy in the sense that we apply this not only for a few satellite products, but really over our whole range of products within Swisscanto. Maybe one note on the passive side, obviously we cannot do this as the allocation, the capital allocation would incur too much tracking error. So therefore we commit in the responsible index products, we commit to a 20% reduction compared to the respective benchmark. And with that, I think I'm finished with my 10 minutes and I would tackle questions later. Thank you very much.
Thank you, Fabio. This was a lot of information that we heard from the 3 presenters packed in the last half hour. Let's start with the Q&A session. Maybe I want to start off with asking Mark, what happens really if Joe Biden doesn't win? I mean, we're in a massive transition. Is that, and of course there will be short-term impacts, but is it longer term, say over 5 years, 6 years? And even through the intermediate time, is this going to really stop what's happening now? And a second question, from a macro perspective, what is the impact of Corona?
Yeah, so let me go straight to that. On the first part, I mean, it looks like Biden is going to win, but if let's just say there is something outrageous, and the esteemed gentleman, I think he was referred to as earlier, does actually unfortunately take the White House back. All it does is delay this inevitable investment phase, and you've got to distinguish between what's happening at the federal level and what's happening at the state level in the US. I think that is so important. Because even with Trump sanctioning, for example, the Keystone XL pipeline, which is taking high sulfur crude down from basically Canada to the Gulf Coast in the US, that doesn't really fill anyone with confidence on his long-term targets with regard to emissions. But at the same time, in the same year, California instigated effectively solar panels for all new build houses to be mandated on residential roofs. So at the state level, there's a lot going on in the US, and investment is already increasing. Even in Pennsylvania, they have a 2050 target of being net zero emissions. Now, Pennsylvania is a big coal and gas state. So at the state level, things are going, but it would be disruptive, and it would slow things down in the US, and it would slow things down globally as well, because remember that Trump basically pulled them out of the climate agreement with the UN, which actually expires today, unfortunately. We expect Biden to reinstate that. That accelerates the cohesion of other partners globally working together to actually reduce these emissions. The second part on COVID and its impact on investments. Now, all of us on the investment team here in March were thinking, crikey, COVID is going to basically slow this down. So COVID is definitely going to have an impact because we're facing so many recessionary pressures. In fact, the opposite's happened though, and Ursula von der Leyen and the European Commission, the Green Deal stimulus program, that's been accelerated as a logical stimulus program for obviously to get the economy going because of the amount of jobs it creates. So if anything, in particular in Asia and in particular in Europe, it's had the opposite effect. Sorry, Ralph, I tried to answer that as quickly as possible.
That's very good. Well done. Thank you, Mark. Question to Fidelity. Which risks are the most important ones? Which should an investor look at first?
Assuming that refers to climate risks, I think it really depends on the
Yes.
on the sector and the issue that you're considering. Obviously, we can sort of break risks down essentially into physical risks. So physical risks that arise from increase in extreme weather events, changes in the global climate, and then the transition risks. And the transition risks are really the sort of inverse, if you like, of the physical risks, because the sort of quicker we address the physical risks and we address the issue of climate change, the more transition risks arise. So in other words, companies like the OEMs, the traditional automakers, obviously have to move to electric vehicles. Utilities need to more rapidly transition to renewables, as do the oil and gas companies. I wouldn't say that either is a higher priority. It depends very much on the sector and the issuer, which one you need to consider most. But I do also want to say that within that, we shouldn't forget and ignore basic principles of portfolio construction, and having a portfolio that is over-indexed, particularly a fixed income portfolio where really we're thinking about the management of downside risks. Having a portfolio that is over-indexed to particular sectors it can be just as damaging for fixed income returns.
Just a question we got asked several times. I just want to mention it here. It seems that the audience is very interested in receiving your presentations. I think as if you're okay with that, everybody can have them after the presentation. Also, I understand that we'll have the presentations. So the speech is actually, the entire session is going to be available to be seen via links right after this event today. So another question on the bond side, Germany and Sweden have issued green government bonds. From an investor's point of view, how do they compare to traditional government bonds? And then are other governments considering to also issue green bonds? And will there finally be a green yield curve and a traditional yield curve?
Yeah, an excellent question. So let me, so yes, other governments are considering issuing green bonds. We've had a number of governments issue already. So in addition to the two mentioned, we've had France, we've had Poland. I understand that the UK is considering issuing green, Spain and Italy as well. I think we're a little way off having a non-green and a green curve. I think obviously the pace at which you can roll out a green yield curve very much dependent on the quantum of projects that you can assign to that use of proceeds. So remember, the green bond is essentially a use of proceeds construct. So you need to have a predefined bucket of investments that are qualified as green in order to invest in. So I do think ultimately we'll get there. I think ideally as a bond investor, I would say I would hope that there would be no green and non-green curve. They would all be one curve because again, you're taking the same risk, you should get the same return. Which then leads me to the final point about how do they compare to traditional bonds? They're pretty similar in terms of well, very similar in terms of liquidity. Maybe slightly less liquid than the non-green version, but marginally. And although I'm not an active investor in the government bond space, I'm more of a corporate bond investor. The pricing differential is a few basis points. So you are foregoing a few basis points of yield, which in this environment, every basis point counts, but it is pretty similar in terms of returns and risks. In the government space, it's a bit more pronounced in the corporate space.
Thank you. Here's a question, I guess, that Fabio could take. Aren't the companies that do the best in terms of climate ratings already a bit overvalued? Or do you think there is still a long way to go and a lot of potential in these companies today?
Well, good question. It comes up, if you're being quant investor, you hear that all over, with value investing, momentum investing, value going through a very hard phase after 30 years now, 4 years being weak. Obviously, the clients start to ask, okay, what happens with sustainability and ESG in general as more and more investors move to it? So I think climate rating is one side, but then there's different strategies. So you have different providers of climate ratings, you have different data providers, you have different approaches of how to look into it. You have people that address it more from the opportunity side. So more in a thematic investment approach where you invest in solution providers in this field. And then you have more, on the core part of the portfolio where you just use simple CO2 data, scope 1 and scope 2 at this point in time. And there we could think, yes, this is sort of comparable. Scope 1 and 2 today is probably mostly standardized to a large degree, so it doesn't really matter that much whether you buy these CO2 data from ESG firm 1 or 2. Pretty much comparable, but whether everything is priced in, then in the end depends on how much capital is moved towards more sustainable products. And often we see today most investors are still doing it with a certain subset of products. If you look at the total market, I think in Europe it's 30 or 40% that say these assets are managed in a sustainable way. Sustainable can mean you do a little bit of exclusions and maybe some engagement of voting, and that's it. So it doesn't mean you have a committed targets. So I think there's a very long way to go still. And then also if you look into passive, a lot of assets are held in a passive way, which mean it's pretty much buying the benchmarks. It doesn't have any impact. So also there, I think it needs more movement, and there's still a lot of upside in the sense of that not all the risks are yet fully priced in. Also, if you look at the carbon price, for example, in the market, which is still fairly low, so these risks are probably not fully priced in. So therefore, I am of the conviction that there's more to come, and we haven't everything priced in at this point in time. No.
Maybe another quick follow-on for Fabio. Outside the energy space, what other sectors do you see as most potential, having most potential, maybe be a bit undiscovered yet from the carbon transition in terms of other industries or other themes, just briefly?
Yeah, there's a lot. I mean, the high emitting sectors or industries are obviously materials. Steel is extremely, and metals per se is extremely carbon intensive. Airlines, very carbon extensive. Transportation, obviously, energy, utilities. So there's several. I think it's seven industries of the 28 industry groups, according to GIEX, make up for over 80% of the world CO2. And then there's the question: do you count only Scope 1 and Scope 2 emission, or do you also look downstream and upstream? Do you start to counting Scope 3, which obviously opens a whole new level of complexity? So yeah. Overall, I think it's not just the energy sector that needs to move. I mean, good example is if China has announced that they're going to ban combustion engines from the road by 2030. So if you want to be in business and sell cars to China, you just have to offer an electric vehicle. And if you have nothing in your product portfolio today, you're going to miss out on a huge market opportunity. So I think this is going to touch so many more sectors than just the energy sector, the energy transition. And then we see a lot of upside, obviously, on also semiconductors, on energy storage, battery, etc. I mean, energy storage will play a massive role. Smart grid will play a massive role in solving the energy strategy, the energy problem out there. If you look in Germany, and on a sunny, windy day, 50% of the energy capacity comes today from renewables already. But the big problem is, what do you do on a windy, on a non-windy and on a cloudy day? You need energy in the grid somehow. And where should this energy come from if it doesn't come from the coal or from the gas plants, or not from nuclear? And I think there we see, there will be lots of opportunities in new technologies that help to store the energy to become more efficient. Smart grid that helps to store energy, in for example, cooling houses, in even a car, even your Tesla car could become an energy saving part, or a battery that can feed energy into the grid. So therefore, this is way more than just the energy sector. And if you look at Tesla's valuation, which is massive, right, then this already suggests you today that the market probably expects that Tesla at a certain point is going to do more than just offering cars to the market.
Very good. Mark, two quick final questions, I guess. I look at the clock here. One is, how many tons of carbon dioxide equivalent has the world saved as a result of Corona? Is there an estimate for that? And maybe we can add, is that temporary or is that long term?
So CO2 emissions definitely dropped as a result of coronavirus, which is obviously a shutdown in activity globally, which is, I think they dropped about 12% at one point, at the worst point in April. But that's just not a really good read though, Ralph, because that was when economies were running at points where they're completely inefficient, because you had capacity utilization at 60 to 75%. Reducing CO2 emissions is not about collapsing industries and shutting things down. Reducing CO2 emissions is about making everyone, for sustainability, because that's the whole point of this conference, is about basically investing in areas which still provide a return. We're not saying you do it for charity, provide a return, but it's a sustainable long-term solution. So does that answer your question? Sorry.
Yes, I hope it does.
Well, I hope it does anyway.
Okay, but the last question is, on the transportation sector, we see the electrical mobility, and we hear about the hydrogen. What do you think? Which way it will take? What will be, those two different types of fuels, future and roles?
So everyone gets excited with electric vehicles, and I mentioned obviously earlier that you're down to less than $100 per kilowatt hour now for a battery pack. That doesn't work for goods transportation. So in order to put a battery in a truck, it's going to be about 14 tons. So if you think about the powertrain you need just to pull the battery, let alone the goods inside the truck, it's just not going to work. Now, this is where the oil majors actually have a glimmer of hope at surviving and reallocating of capital. And the reason being is hydrogen is going to be a big part of the energy mix. Hydrogen, not just for transportation, but hydrogen in other industries that Fabio mentioned, like steel, for example, like in cement and agriculture. And at the moment, hydrogen is not economic on a green hydrogen basis, which is basically producing hydrogen using renewable power, for example. Where we think there's going to be big growth in hydrogen is actually on what we call effectively grey hydrogen, which is basically grey hydrogen produced from natural gas, and then you apply the carbon capture as an overlay over that, which is why when Fabio talks about other industries that are going to take off, carbon capture is a massive industry which will work side by side with the electrolyzers in the hydrogen industry. Now, we have to bring this back to valuations. Hydrogen is going to be a massive growth area, but caveat to everyone on this call, don't run after everything exposed to hydrogen, because some of these names are implying returns on invested capital of 150% into perpetuity, which everyone on this call will recognize that is absolutely impossible in a manufacturing industry, and those returns will get competed away. So to say the sector's got hot in some areas is an understatement. So hopefully that gives you a little bit more than you're asking for in that question.
Thank you for this. We're now coming to the end of our webinar. Indeed, we've actually run over a couple of minutes, but I think it was worthwhile doing so. But before we close off here, I would like to inform you on behalf of the Finanz und Wirtschaft team that the Forum Opportunities 2021 this year will also provide a live stream option for you to participate. And you will receive an email with the link and further information about this shortly. I hope specifically for the participating audience of investors that you have benefited from this session, have hopefully been able to deepen your insight into the opportunities within those investment frameworks discussed today. And I would also encourage you, for any further questions, or just also if you would like to have a private conversation, to reach out to the presenters and follow up on that. I thank you all for joining today, specifically also Mark, Christian and Fabio for the presentations, and the Finanz und Wirtschaft technical team for making this webinar possible. Have a good evening, everyone, and goodbye.